Sebastián Vedoya, que es abogado, socio del Estudio Bruchou, es especialista en Derecho Ambiental y Derecho Minero, y por otro lado es un baluarte del Instituto Argentino de Derecho para la Minería, colabora activamente y es integrante de nuestra comisión directiva. Dicho esto en español, solamente saludar a Erik. Good luck with your presentation. Try to be nice with the Argentinian stamp tax. Alex, you are the business guy, so show us the money. Eh?
This is going to be great. Oh, it's going to be a lot of fun. So looking forward to this.
Sure. Good luck. Bye-bye.
Okay, so thanks, Leo. Again, I'm not Marcela Gonzalez, so I'm Sebastián Bedoya will be moderating this panel. This panel will be conducted in English, as Leo said. For this panel, which is focused on royalties and streaming agreements, we have Mr. Alex Zuckernick, and Erik Goldsilver, which also join us, and Mr. Richard Fridman will be hopefully joining us very soon. Thanks to our panelists for joining us, and thanks to our audience for being there. So before starting, I will briefly introduce our panelists. Alex Zuckernick co-founded Nova Royalty in 2018. He has over 15 years of experience in metals and mining finance as an executive, investor, and corporate advisor. Before Nova Royalty, he spent more than 7 years as an independent principal of his own merchant banking advisory firm, Sintella Partners, where he focused on creating value-added investment opportunities in the mining space. Prior to becoming an independent principal, he co-founded the Metals and Mining Investment Banking Group at Rodman and Renshaw, where he was director and head of metals and mining, and involved with over $2 billion of completed mergers, acquisitions, and capital raising transactions. Before that, he was a founding professional and vice president of Miller Mathis, a merger and acquisition advisory firm focused on the steel industry. He began his career in the investment banking group at JP Morgan. Alex earned an BA in mathematics and economics from Cornell University and an MBA with Beta Gamma Sigma honors from Columbia Business School. He also holds the CFA charter. Our second panelist, Richard, we have Richard. Hi, Richard. It's okay. It's Richard Fridman. Richard is a partner at Davies, Phillips, and Vineberg LLP in the mergers and acquisitions and corporate commercial practices, and he's a principal member of the firm's mining group. While his practice spans multiple industries, Richard works most extensively with clients in the mining and energy sectors. In addition to advising clients on all aspects of M&A, Richard possesses expertise in various aspects of mining law, including joint venture and earning agreements, precious metal streaming transactions, royalties, and offtake agreements. Richard acts for major producers, junior exploration companies, and private equity funds with a mining focus. Richard holds Bachelor of Civil Law and Bachelor of Common Law degrees from the University of Ottawa, where he graduated as the gold medalist, and a Master's of Law degree from New York University. Before joining Davies in 2002, Richard worked as a management consultant with McKinsey & Company. He also clerked with the Honorable Mr. Justice Charles Gonthier on the Supreme Court of Canada in 1998. Our third panelist, Erik Goldsilver, is partner of the Canadian law firm BLG in the mining, capital markets, M&A, corporate finance, and commercial contracts areas of practice. Erik practices corporate and securities law with an emphasis on mining and natural resources. He acts for Canadian and international mining companies on acquisitions and disposition of mines, mining projects and mining companies, project development, and mine operations in Canada and throughout the world. Erik advises on the structuring and negotiation of option and joint venture agreements, shareholder agreements, royalty arrangements, streaming transactions, and offtake agreements. He has extensive experience with all legal aspects of the development, construction, and operation of mining projects, including advising on Aboriginal issues and claims, environmental and regulatory compliance matters, permitting issues and mine closure, decommissioning and reclamation issues. Erik also advises mining clients on energy-related issues, such as power procurement, interconnection, and transmission services. Finally, Erik holds a bachelor's degree from the Western University and an LLB from the University of British Columbia. He was admitted to bar in Toronto in 1999, and he's member of the Canadian Bar Association, the Ontario Bar Association, the Ontario Energy Association, and the Rocky Mountain Mineral Law Foundation. So this is the introduction of our panelists. Thanks again to them. Before starting with addressing specific topics on royalties and streaming, our panelists will give us an overview of the commercial and legal aspects related to royalties and streaming agreements. Alex, if you can please take the lead on introducing us to the commercial side of this topic.
Happy to lead off. So look, just again, as far as background, I'm one of the co-founders and the president and CEO of Nova Royalty. We're listed in the Toronto Venture Exchange under the ticker NOVR. And really, what we set out to do was start the first royalty company that's really focused on copper and to a small degree nickel. So whereas most of the royalty and streaming has occurred in the precious metals sphere, we really felt that the royalty and streaming model was really where the industry was going to go in terms of financing itself. And I think you're seeing that now much more. Debt providers, I think, are increasingly nervous. I think banks have higher and higher hurdles to committing money to project finance for mining projects. I think the equity markets, kind of get spooked very easily in the environment we're in today. Whereas I think a royalty or a stream provides a much more transparent way of investing in a project, because you know that there's a defined payback. I will get X percentage of the revenues. I'll be exposed to the best of the equity side, which is asset expansions and commodity prices. At the same time, I will also have some sort of fixed mechanism by which I get paid back, whether it's some percentage of revenue, say 2 or 3%, or if it's a stream, it's going to be some percentage of production that I'm going to be able to acquire. I think it gives investors much more certainty, which I think is really the element which is most lacking in the markets broadly right now, is that people are very nervous about all kinds of things. And I think what the royalties and streams do is they combine really the best of the both worlds of the debt and the equity, and which is why you've seen them proliferate so much in the sector. I mean, I remember going back to the 2000s, and even the leading companies in the royalty and streaming sector, so like Franco, Nevada, and Wheaton Precious, which was back then Silver Wheaton, and the Royal Gold, they were a fraction of their current market caps, just because the overall perception was that this was going to be a niche mechanism that would be occasionally applicable, but not something that really would become industry-wide. And obviously the big gold miners at that time, not to mention the big diversified miners, were much, 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 much bigger than these companies. And I think what you saw happen in the early 2010s was really a change in the paradigm, because unfortunately some of the bigger miners got into real difficulties in terms of overspending on acquisitions and balance sheet issues and cost overruns and things like that. I mean, I think the unspoken part in every commodity cycle is that as much as prices rise, profits actually don't rise that much. Because what happens is capex, acquisition spending, inevitable inflation on the production side, where communities expect to get higher wages, governments expect to get higher royalties, taxes. They all catch up to the bottom line much faster than I think people want to acknowledge. And so when these things began to occur, you really saw the royalty companies become the preferred mechanism for gold investors, precious metals investors, to own the commodity. And so you saw actually a scenario where the royalty and streaming companies were financing some of the more balance sheet constrained diversified miners. So Franco and Wheaton made multiple investments in projects owned by the major diversifieds, because they had a much more advantageous cost of funding than those companies did. Because again, if you can have a multi-billion-dollar company with a very small staff, I think in Franco's case, I think it was something like $1 billion per full-time employee at one point in terms of market cap. It's really incredible how scalable that model can be. And you have a low cost structure, and you have a long life projects with something that kind of is owned by the best counterparties. It's really the best exposure to the commodity you can find, and these projects get bigger. And so I think investors began to understand that, and you've really seen a big rotation in terms of preference away from the miners toward the royalty and streaming companies. And I think when you look at the sector now, it's much bigger. There's a lot more companies. We're one of them. We're really we saw ourselves as being the first ones to really take it into the base metal space in terms of a focused copper player. And then, overall, when you look at even the project finance side of it, you now see royalties and streams comprise roughly, let's say, 1/3 of the total project capex. And that's become a mainstream idea. What used to be considered something that was niche or unique, now I don't think it's that unique. I think it's just standard. You want to go build a base metals mine, you stream your precious byproducts, whether they be gold, silver, or anything else, in the way that makes sense, and you protect your primary commodity. So I think that just the basic principle of getting your money back via some percentage of production, which protects you against inflation, and gives you, which, of course, if you listen to the Fed now, they're now saying that inflation is not transitory. I think Powell just came out with that yesterday. So inflation is now a concern that this is not something that's just going to go away. You have to actually actively protect against that. It's very hard to lend in an inflationary environment for the obvious reasons, right? Because what's going to happen is you need to go and start attaching things to your debt instruments that make it prohibitive for any borrower to actually agree to it. Otherwise, you may find yourself getting afraid that you're just going to get wiped out via inflation, even if the project performs. So I think the royalty is uniquely set up because it gives you both the offense and the defense that you need, and the stream too. I'm just they're two different. They're very similar instruments, just somewhat different in structure. But you can cover for inflation. You get the asset expansion advantages. You also get paid back some fixed amount. You don't need to worry about management discretion. Management doesn't have discretion about whether they get to pay a royalty. I think it's a pretty straightforward situation. It's not like a dividend. So really, my sense is that we're at the beginning of this sort of just change in what investors expect from the sector, and I think royalties and streams are just a simpler way of investing in it. We made an investment in the Taka Taka royalty, 2 investments actually. And in 2020 and early 2021, and we felt that this was really the best way to get exposure to a project of this quality. Obviously, it seems to be moving ahead very well, and First Quantum is very motivated to see it get into production. But again, you look at why investors have backed Nova. I think when you have the opportunity to get a life of mine royalty on a top-notch project like that, which is run by such serious, experienced people, and we didn't buy it from the company, we bought it from an existing royalty owner. It's really a unique proposition, and copper is not an easy business, and obviously you have your pitfalls, and here you get a percentage of revenues life of mine from a top-notch project, which is going to be developed by one of the best companies in the world. So it's really something that I think is just only beginning to get into the consciousness of the overall investor universe. I think I live in New York City, and very few people here really understand mining, and even fewer people here understand royalties. But I think when you understand the beautiful sort of pieces of that kind of investment in terms of protections and upside that it gives you, I think it's unlike anything on the planet right now. Because it allows you to participate in what's happening, but you're also protected against some of the worst things that can happen. So look, that's kind of my general sense of where we are. I think we're early days in something that is becoming more and more mainstream, and I think you're going to see a lot more different applications legally, commercially, a lot more variations to the standard structures that we've seen.
Thank you very much, Alex. In fact, we've seen last couple of years, we've seen very active royalty and streaming companies around here in Argentina. We have a lot of experience in inflation too, so
yes.
It's perfect timing for these kind of things, right? So Erik and Rich, maybe you can give us an introductory overview of from the legal standpoint. You choose who starts talking about this.
Look, I'm happy to go, and I would echo what Alex said. I mean, if you go back to the origins of streaming and silver wheaten, right? It was initially an effort to try to monetize a byproduct for which at the time wheaten wasn't getting value. So they created silver wheaten. They spun off the silver stream, and they were able to extract incredible value from it. And just playing on what Alex said, this is a market that McKinsey did a study on in 2010, had a value of about $2 billion, and in 2019 had a value of about $15 billion, just in terms of new creation of streams. So clearly becoming much more mainstream. And on the same point, I think in 2020, based on gold equivalent ounces, still about 95% of the streams were in the precious metal space. I think 2% would be in copper and 1% for cobalt, palladium, and some of the other battery metals. So I think you will see a lot of growth. From a pure legal perspective, obviously, and we can get into this in a little bit more detail afterwards, but the royalties and streams are kind of two sides of the same coin to some extent. They are these lifelong annuities, if you will, that will continue to pay as long as the mine is operating. But from a purely legal perspective, there are distinctions to be drawn, right? A royalty is viewed as a right in the land and has certain incumbent or ancillary consequences of that. A stream is a contractual forward contract, effectively, where you're laying out cash up front as a deposit against future distributions of metal. And so, again, we can talk about this in a little bit more detail afterwards, but if you're looking at this from the perspective of a streamer, you're starting to think about the viability of the company, the capex it has to throw into it, the economic climate, and the risk of insolvency, because there are very different consequences potentially in the context of a stream versus the context of an in-rem right in land, which is the royalty. And again, royalties will also vary by jurisdiction. In some cases, they are registrable on title. In other jurisdictions, they're not. So there are a myriad of protections that streamers and royalty companies will look at as a means of trying to ensure that they can secure their position, particularly in circumstances where the initial outlay on a transaction, on a stream, on a royalty is significant, and you're trying to protect that investment longer term.
Thanks, Rich. Erik, you want to comment on that?
Yeah, no, the only other thing that I would add is that, we typically look at royalties as more of a passive investment. You make if you're providing financing by way of a royalty, you pay the upfront amount and you receive typically cash from the mining company from gross revenues less certain expenses, and it's a monthly or a quarterly or annual payment. On stream, it's more of a purchase and sale transaction where you're actually purchasing. The streamer is purchasing, the mining company is selling specific quantities of metal, gold, silver, copper, etc. So two different kinds of transactions from a commercial perspective. One is more of a passive investment, one is more of an active business operation where you're buying and selling a commodity on a regular basis.
Okay, well, thanks, Erik. With these introductions, I would ask our audience if they have questions. We'll be covering some specific topics about the royalties and streaming agreements. If you have any questions, please use the Q&A option of the Zoom platform. So just jumping on the specific issues, Alex, I would ask about the key differences between royalties and streams, and if there are benefits of choosing one over the other.
Yeah, look, I mean, there's the main difference is, kind of from the perspective of commercial, a royalty will give you typically a life of mine revenue of some percentage of the entire mine. Sometimes it'll be specific to the commodity, but I would say that much more likely than not, it's just going to cover all the revenues from a specific project. And your typical royalties will usually range up to 3%. There are some bigger ones, but I think those probably stand out as exceptions. I think the prevailing wisdom is you generally don't want to see projects be encumbered above 3%, because again, it's easy to discount the number is small, but that misses the capital intensity of the business, because mining just requires ongoing capital, and then there's cost and the like. So, once you get into sort of the 5-6% range, I mean, I really do think that can have a material effect on the ability of the management team to sort of run the business without thinking about the royalty. I mean, I think the ideal royalty is one that's seen and not heard, I think is probably the best way I would put it. It's something that sits there. The original idea behind royalties was that you would give them to prospectors or whoever finds the project in exchange for selling the projects to the mining companies. And that's sort of their upside participation. So they're meant to be upside participation. They're not meant to be something that really makes a material difference in the financials of the project. So for instance, what Nova has done, most of our activity. In fact, all the major investments have not been investments directly into the companies, but buying these existing royalties, which we thought would be they wouldn't interfere too much with the ongoing operations of the projects, and we would buy them from the original prospectors, because we have the ability to be more patient and wait in the diversified public vehicle than an individual family kind of who holds the prospect by themselves. A stream is something different. A stream is typically created as a direct investment into the company itself, and typically that happens when you need to build a project. So the way that I think the most successful streams have worked is, if I have a base metals primary mine, and that accounts for ideally 80+% of my revenues, hopefully 90%, but something very high. And I have some byproducts, which usually we say gold and silver. I can sell those byproducts to a streaming company in exchange for minimizing my upfront capex. And typically, and that's where the companies, if there's leverage ratios you don't want to trip over, or if there's equity dilution you don't want to undertake, which obviously can occur in a challenging market, or just in terms of overall considerations on capital structure, I can go ahead and sell some percentage of my future precious metals production, which is a small minority, hopefully, of my overall metal production, to a streaming company for an upfront payment. Typically, the way that will work is I will receive, say, $200 million in an upfront payment, which will go to defray my capex. In exchange, I will sell, say, all of my attributable gold and silver production for, say, 20% of spot price life of mine. And so that may or may not be an attractive proposition, and obviously companies kind of spend their time figuring out what they want to do. So you can make it typically streams will fall into one of two varieties. You'll either be selling your future production for some floating percentage of spot, or you'll be selling it for a fixed price. So whether say $5 silver, or $6 silver, whatever the price is, or $200 gold, $300. So that's now depending on the jurisdiction. Now the stream is never sits on it as a title to the land. It's a capital structure instrument. So, to the degree that there is any solvency issues, or God forbid bankruptcy, a stream then gets treated. I mean, I do think actually it's still very early, as I understand, in terms of how they're treated, because there's no defined treatment. They're not quite a liability. It's sort of a nebulous area, but they're also often secured against the assets. A royalty in the best cases will be secured on the land itself. So if you're in the US or Canada, it's pretty straightforward. If you're in Latin America, they will typically be a direct obligation of the issuer itself. And so, but you can't really register it on the land. So, I mean, then I don't want to get too far into the legal issues of this stuff, but I think fundamentally streams are usually bigger, because you're using them for project finance. You're not just, these aren't, this isn't a royalty that's given to a prospector so he can participate in the project. Like the stream you take out because it's meant to be a way of materially defraying your capex cost. So I think, by nature, just speaking frankly, they probably carry more risk for both the investor and the issuer because of the magnitude of what you're asking the instrument to do. Now, royalties can be very large, no question. But again, I would say, if you look at the capex, the way the capex has been financed much more through streams than through royalties. It can be done in the royalty, but it's just, it doesn't always lend itself to that. So I think they're very similar, but kind of, I think it'll, depending on whether, if it's a project finance or just sort of an acquisition of an existing instrument, then you'll just see differences in structure.
Thanks, Alex. I can see that in your mind, a lot of legal issues were rising as you were speaking on commercial. So
I can't help
sure,
it. Sorry about that.
I'm sure, and on my mind too. So I think Erik and Richard had a lot to say about this. Erik, you want to start?
Sure. I typically agree with Alex. Historically, royalties were not a major way to raise money for capex or for mine operations. But we are seeing larger and larger royalty transactions. And you know, a lot of times the differences between a royalty or a stream comes down to tax structuring, and depends on the jurisdiction of the streamer and the jurisdiction of the mining company. So that's always top of mind when deciding whether to do a stream or a royalty. You know, what are the tax implications? You know, again, I go back to my initial comment. You know, the key differences from the royalty and a stream. The stream, you're typically receiving cash payments. You can receive in-kind payments, but those are becoming, in my view, you know, rarer and rarer. Whereas with the stream, you are receiving ounces or you know, other units like, you know, pounds or tons if it's copper or a base metal. And so it's really you know, as the financing company, do you want to receive cash payments or do you want to receive you know, the metal itself? I know, you know, for example, you know, Wheaton Precious, they do not do royalties. They have never done a royalty, and if you read their marketing materials, they will tell you that they will never do a royalty. They never say never, but that's their view. Whereas a lot of the other, I think most of the other streaming royalty companies will do both, and it really just depends on the economics of the transaction. Every transaction will be different.
Thanks, Erik. Rich, you want to add on that?
The only one I would add, and it touches on something Alex said about royalties typically being in kind of the 1% to 3% range. I think we're talking about net smelter returns royalties, which is basically gross revenue less expenses. And to put it into perspective, there's another kind of royalty called the net profit interest, which is payable on profit after the miner has basically recovered its capital costs. And you can see NPI royalties of 20 to 30% that return a lower rate than say a 2.5 or 3% NSR. So that gives you a sense of the capital invested in the mine and the costs of recovering those, which is why you tend not to see net profit interest royalties anymore. There's a lot of controversy when it comes to determining what the capital costs are, trying to recover them. The prevailing royalty, and the one I think we'll be talking most about today, is the net smelter return royalty, which certainly in the precious metal space makes up probably 95% of the royalties I come across.
Okay, thanks, Rich. And just jumping on streaming agreement, Rich, maybe you can tell us about the different structures streaming agreements may have, and the most common structures you can see, and pros and cons of each of them.
Sure, and again, that's a little bit of a loaded question, because I think you got to look at it from two perspectives. One is, what are the types of streams? And I think Alex has already touched on that to some extent. And the other is, then how do you structure them? And there's no real magic to streaming agreements. They tend to follow a prescribed form based on who it is you're dealing with. You know, Wheaton has their style, as does Royal, as do the other streamers. But ultimately, I mean, starting with the types of streams, as Alex pointed out, these were typically precious metal streams, usually byproducts. But as the model matured and as companies found themselves trying to clean up their balance sheet, you saw primary metals being streamed. So it wasn't just byproducts. You had gold mines streaming 5, 6, 7% of the gold produced. And that was, again, coming off of the M&A boom of the 2010 era, where people were overpaying for assets and then found themselves on the down cycle of the commodity and having to fix their balance sheet. And again, as the model matured, you started to see more primary metals get streamed. So you do see copper streams now, you do see zinc, you do see palladium. And frankly, I've even seen diamonds being streamed. So again, imagination is basically the limits on what you can stream. And another interesting concept that materialized a few years back is really syndicated streaming. So because a lot of these agreements are big dollar figure agreements, and not everybody has the balance sheet of a Franco-Nevada or a Wheaton Precious Metal or a Royal Gold, you saw some of the smaller streamers get together and basically syndicate a stream. They put up the money and they would, as a consortium, fund the deposit on the stream. So that's kind of big picture about how the streaming model has expanded. But in terms of how they get structured, and what's even more interesting is how it's driven by jurisdiction and tax law for the most part, because at its genesis, a streaming agreement is nothing more than a forward sale of gold with a significant upfront deposit. But it ties back to production from a mine, which intuitively makes you think the mining company should be the streamer. But if you think about it, a parent company can have multiple subsidiaries, one of which may hold the mine. But when structuring a stream, in order to get the greatest tax efficiencies, what often happens is the company whose mine is being streamed is not the party to the streaming contract. Rather, you use what we call a synthetic structure, where the subsidiary of the parent company in a low tax jurisdiction will be the seller under the stream, and the deliveries of metal will be tied back to production from the mine, which is sitting in another subsidiary in another jurisdiction. So effectively, the seller under your streaming agreement will purchase the commodity. I mean, it can technically purchase the commodity from anywhere it wants, but will typically purchase the commodity from the mining company in the same group of families at spot, and then we'll sell it at that percentage of spot under the streaming agreement. And that can avoid higher tax rates in the jurisdiction where the mine is located, or in some jurisdictions, an assertion that a streaming agreement is actually an interest in the mine being sold. If the company that owns the mine is not a party to the mining contract, those issues go away. So those are the benefits of the synthetic structure. The flip side of that coin, however, is the streamer itself is going to want to protect its investment, right? And so you have a structure now where the company that holds the mine is not a party to the streaming agreement. So again, nothing you can't fix through contract, but effectively what you would do is you would have a series of covenants whereby the parent company that sits atop the corporate family will commit to cause the mining company to do a series of things, will commit to provide certain information in respect of the mining company, will commit to provide off-taker information, and so on and so forth. And then what you'll have is security granted all the way down the chain, so that all the shares in the companies that hold from the top all the way down to the mining company are pledged as security, so that if something does go awry, there's recourse to the asset. So fundamentally, I think you'll find that that structure is pretty common. And that's why when you're dealing with the likes of Wheaton Precious Metals, for example, they'll have an entity set up offshore, and oftentimes the companies with which they're streaming are not the entities that hold the mine, say in Argentina or in Canada, but they're located in some other jurisdiction.
Thanks, Rich. Very, very interesting. Erik, you have a comment on that?
Yeah, no, the only other thing I would say to echo Richard's comments, and just to make sure it's not lost on the audience, is that under a stream agreement, you don't have to sell metal that is produced from the mine. It is typically metal based on production, but the gold or the silver or the copper can come from typically any source around the world. You can contract with a refiner somewhere to deliver an equivalent amount of the metal based on production, but it typically does not come from the mine itself. The other thing, and I'll raise this, and we could spend a lot of time talking about it, but given the sort of the worldwide push to minimum corporate tax rates, some of the offshore structuring issues may become a thing of the past. I know a lot of streamers are talking about potentially moving things back onshore. Probably too soon, because we don't know exactly what the minimum corporate tax is going to look like and how jurisdictions are going to incorporate it. But that's probably something that's coming down the pipe.
Thanks, Erik. Alex, any comments from the commercial standpoint?
I think Erik's last comment is very much on point. I think that you're definitely, I think the opportunities on the tax side that existed before, just seeing from everything happening, I think probably won't be what they were for sure. I think it's just going to come back to very simple asset underwriting, and I mean that's really all the industry is going to be.
Thanks, Alex. So we have been familiar for years with royalty agreements down here. Not that much with streaming agreements, which is something I would say not common, new, being presented by companies down here as an option. But I don't think we have a deep knowledge of the impact of these kind of agreements in the ability of a company to develop and operate a mine. So are there differences between the development stage projects and operating mines? How this works with streaming agreements, Alex, please.
Well, I mean, as we all know, mining is an industry with no risk. So it's really easy to build a mine. Just ask anyone. I think. I mean, look, it's the biggest difference between royalties and streams. I don't think it's so much a matter of structure. It's just a matter of size. So typically, if you go into again, a streaming agreement will much more likely than not be put on a development stage base metals mine. And that's probably been sort of the bread and butter to date. And so you're going to be streaming the precious metals byproducts. depending on the quality of the mine, depending on the quality of the operator and the overall technical and commercial strength, it can either be something that's barely noticed or it can become a real problem. And I think that, you know, the biggest issue I think that the streamer has to just evaluate for themselves is, you know, are they investing in an entity which can handle the quantum and the capital structure without straining, or is this something you're going to have to be restructuring multiple times over to make sure that things can continue going as expected. So I really think that you know, as much structuring as people have done, it really does come back down to the basics. What's the asset? What's the company? You know, kind of how viable is all this? Is this really a long-term mine that can put significant capital into? Does the operator really have the ability to deal with this? And then hopefully you size your investment accordingly. I mean, I think what it does speak to the industry's credit that the biggest streaming deals have been spectacularly successful. You know, because they were put on really high quality mines owned by great companies, and I think you've seen really just great performance. And I think that's why Franco and Wheaton have become such great companies. I think they've done a great job of underwriting the risk levels very well. Ironically enough, I think the problems happened out of the top end, because I think the good companies really handled their affairs very well eventually. Even when they struggle initially, they handled their affairs eventually very well. It's at the middle end where I think the real problems come, because the operators, or the smaller end, because the operators are not as strong. They don't have the wherewithal to get through hiccups and mistakes with the same ability of the larger companies. Overall support base is just not there. The capital markets are not quite as robust. And I think that's where you potentially run into some issues. So I think, you know, if you're going to go and underwrite an asset outside the top tier, I mean, then you've got to be really careful on sizing and making sure that it can handle it. So that's probably where, and ironically, that's probably where you've seen some of the biggest percentages of revenue in terms of royalties and streams happen, is on these sort of smaller assets. I think that's where you potentially have some real issues, because you're asking something that's not necessarily as strong as you want it to be to carry a big load. And I think unless everything goes just perfect, I think that's where you can have some issues.
Okay, so why choosing streaming over conventional debt? That depends on the kind of project, or it's an outside factor. Are streams considered indebtedness? How does it work?
I mean, that's actually a phenomenal question. You know, I think I'd love to hear what Richard and Erik have to say on the subject, because I think it's still very new, the treatment of a stream within the capital structure, particularly if you are in any kind of distress situation. I think the reason that you would choose a stream over equity, I think, is pretty straightforward. If you have a share price which you don't think reflects the value of the company, then a stream can be a very discrete instrument and a specific asset that allows you to raise capital without any dilution. Vis-a-vis debt, I think there's some advantages. You know, it's not, and that literally just depends on how you structure it. You know, the bells and whistles, but in theory, anyway, it's not a parent level secured obligation that can impair a company's overall capital structure. Usually you'll be sitting at the asset level, but if you look at how these have been structured, they're effectively structured as parent obligations as well. So I think it just becomes much more specific. I think what a stream allows you to do versus debt, the biggest advantage is you pay when you produce, typically. Or at least they're meant to be structured in such a way that an obligation is triggered only when the company actually produces, and it's not a fixed repayment schedule like that. However, streams typically also have minimum repayment schedules if you actually look at the agreement. So it becomes very specific, you know, kind of in terms of how they're structured, because there's so much customization. But in theory, at least in terms of how they started out, they were meant to be much more benign instruments than debt. They couldn't just force you into bankruptcy with the same speed. You know, you didn't have the same fixed repayment schedule. You typically would pay only when you produce. So they would go much more at the speed of the operator than your typical debt repayment schedule. That's kind of that is the hypothetical big advantage. And that's why royalties and streams in general probably more attractive, is that they reflect the reality of the operation much more than a fixed debt repayment schedule, which doesn't care, obviously, kind of how they do. They just want their money back.
Great, thanks, Alex. Very interesting. So, Erik, you want to comment on that?
Yeah, I was going to say that if you ask a streaming company or a mining company if a stream is debt, I think the unequivocal answer will be that no, it is not debt. And both streamers and mining companies go out of their way to ensure that a stream is not categorized as debt, because nobody wants to have a stream instrument on their books as debt, and it's not meant to be that way. I know a number of years ago, when a lot of the large diversified mining companies were looking for stream financing, and Richard will know this, you know, Standard & Poor's came out with a policy paper on whether streams constitute debt, and they basically had 5 or 6 categories and said, if you meet these categories, we will not treat this as debt. If you don't meet these categories, we will treat it as debt, and it will impact your credit rating. Now, that's obviously a bigger issue for companies that actually do have credit ratings. If you're a junior mining company or an intermediate mining company, it's not much of an issue. But the senior, more diversified mining companies are very, very strict with ensuring that any stream that goes onto their assets does not impact their credit rating. So typically, streams are not considered debt.
Yeah,
Thanks, Erik. So Richard,
echo that, and I dealt with S&P on this very issue, and trying to get them to give you some guidance as to what indicia are going to put you over the edge in terms of characterizing a stream as debt is like trying to pull a rattle away from a baby. They grip it real tight. Go. I mean, I think what we can say with relative certainty is a lot of the protective mechanisms that you find in streams will tend to push these products towards the debt side of the ledger, if you will, from an S&P perspective, right? So if you have delivery obligations, even when metal isn't produced, for example, or obligation to refund the deposit if you don't achieve certain thresholds, so an acceleration. Security and collateral are big faux pas, as are broad parent guarantees, and then ultimately the rationale for the stream, right? If it's used in lieu of borrowing to fund capital, that's a big indicator from the perspective of S&P versus are you using it to pay down debt on your balance sheet? So those are kind of the characteristics you'd look at. And again, they only come up insofar as you are a credit rated entity, and more so in the context of those companies who were trying to improve their balance sheets in the wake of significant expenditures. And just quickly to touch on, we talked about the positives of streaming versus conventional debt. And obviously you don't have debt-like covenant packages in streams, right? They are really hands-off in terms of a non-participatory interest. But the downside of streaming, of course, is twofold. One is streams are life of mine. So some would argue short-term pain of taking on project finance, again, assuming it's available to you, is preferential because you can model that out based on the life of mine and calculate your returns. The thing with a stream is if it's well structured, and they tend to be well structured, it'll cover further exploration upside, right? So if you discover an additional deposit, which may not have been modeled in the early days, the stream is going to apply to that deposit, whereas your project finance may not. And then, of course, there's just the dilution factor. So we talk about dilution in the equity context as being broad-based and a stream being very targeted dilution, but you are effectively diluting the value of the asset when you enter into a stream agreement. And again, that's not to say that streaming is not a favorable option in many circumstances. It certainly has been, particularly to the mid-range miners who have been unable to tap the debt markets. And with inflation being a prevailing concern, it seems likely that finance in the conventional sense of the word is going to become even more difficult.
Thanks, Rich. I think we have a pretty good idea of what royalties and streaming agreements are. Thanks to the panelists for that. So I think we are ready to go deeper into some specific topics. Maybe Erik can tell us about the prevailing practice regarding secure or unsecure agreements.
Yeah, sure. You know, whether a royalty or a stream is secured or unsecured really comes down to a credit risk analysis of your counterparty. And if you know, the obligations under the stream or the royalty are significant, and the streaming company you know, has concerns about the ability of the counterparty to pay or to deliver, they will typically take security over ideally project assets, but also share pledges up a corporate chain to ensure that the obligations under the stream or the royalty are performed or satisfied. And so what that means is typically the senior producers, the diversified ones, their streams are typically unsecured because their credit risk is typically minimal. Whereas when you're dealing with intermediate or junior companies, you're typically going to see the royalty agreements or stream agreements be secured. In terms of security, it's a negotiated point. A lot of times the streamer will require, full asset level and subsidiary level on the risk assessment. A streamer will consider.
So it's me or it's Erik?
I think it might be Erik.
Okay. So we'll kind of unplug Erik. Richard, you want to add to what Erik was saying?
Yeah, no, I think Erik hit on the highlights, which is it typically goes to the credit quality.
Taking.
Oh, there we go.
Less security, but it's really a negotiated point. And
so Erik, we were having problems hearing you, so we jumped to Rich.
Yeah, sorry about that.
It's okay.
I think my internet connection went down a little bit. I apologize.
No problem. Just complete your idea, and let's jump to Rich after that.
No. I mean, if Richard was talking, he can continue.
Well, again, I think you hit on the highlights, right? It's negotiated. The only thing I would point out, a trend that I'm starting to see more prevalent in the streaming space is you start with particularly on early stage projects, a very comprehensive security package that covers, Erik, effectively what you were alluding to, which is the chain of title all the way down and the underlying mining project. But once the deposit is paid, or potentially once the mine is brought into commercial production, the mining level security is often released. So you do see a release of the security package as the risk profile of the project goes down.
Yeah, I would agree.
So from the commercial standpoint, Alex, probably you always want a secure agreement, right? Or no? What's the rationale behind accepting an unsecure agreement from the commercial standpoint?
I mean, I think the issue with security in general is in mining, these assets aren't self-sustaining in a way that, say, a normal industrial plant or a supermarket is. If a supermarket goes bankrupt, nothing changes, just the capital structure can be flipped. In mining, if God forbid something goes wrong, you have a material impairment at the asset value level, which happens very quickly. So, I mean, I think from our perspective, the way we see it was our job is first and foremost underwrite the assets and the management teams. That's your real security.
Fair enough.
If God forbid you get to the point where you start having to check what's in your agreement, I think you've got a big problem no matter what's in that agreement.
No, I think that's right. And you are really underwriting the management team. I mean, I worked on what I think was the first totally unsecured stream agreement, and it was Royal Gold Stream over the Pueblo Viejo mine in the Dominican Republic. It's Barrick's significant gold mine. It produces about 1 million ounces a year. And again, it was a hurdle in the sense that the model hadn't previously seen an unsecured agreement, but I think there was sufficient comfort in the operator, in the quality of the asset, and in the ability to meet the delivery obligations that ultimately the parties got comfortable that it would be an unsecured obligation. Now, there are the odd protections in place, but fundamentally, if God forbid the worst case scenario played out, it would be a fully unsecured agreement with the incumbent fallout that would come from that.
Yeah, I mean, look, I think I mean, just in terms of deal mechanics, right? It's, you never get everything you want in a transaction. It's about what are the primary things that you actually need. Asset quality and management obviously are the top two things. Then in the structure, there's a level of reasonableness, I think, that prevails in terms of what makes sense and what can be achieved. I mean, look, obviously, if you can get security, it's great. you would prefer to have it rather than not. But it's really a question of where that fits in the context of the overall transaction in terms of priority and what can be done. I mean, I would just caution on that, because getting tied up in the details, while relevant, it's not really what you're trying to solve for. I mean, we pursue assets for years, and so if we really want them, and just you wait for your opportunity. At the point that you get there, you have your checklist of what's really important to you, and you just try to get through it as best you can. I think that's just the way that these things get done.
No, I think that's right. Again, as lawyers, we're in the business of risk mitigation. As business people, you're in the business of risk evaluation. And ultimately, if the upside favors taking the risk, then you're going to take it.
Yeah, I mean, and I think that it's just a quality issue overall. Is if you when you look at what's performed, whether it's assets, whether it's streams or anything else, it's really the top end of the spectrum. And I think I think the companies that find a way to be involved in those projects, and I think they're the ones to benefit. If you actually look at some of the big streams that were written in the middle of the last decade, they didn't have very high yields up front. I think the companies that Franco and Wheaton did a phenomenal job, and hats off to the foresight. They were smart enough to take reasonably low yielding deals in the front end, but these assets performed. They were given with great companies, and they got a lot of, they got a lot of criticism from the markets, saying that, oh, you're giving your money away too cheaply. Well, if you look at how those deals are yielding today, I don't think anybody's saying that. So I think it's, and you've got a long way to go, which is the best part. So I think people who find a way to associate themselves with the best operators are the ones who will be successful, and hopefully you also have provisions in there that are reasonable as well.
Thanks, Alex. So jumping into royalty agreements, Rich, what are the most important aspects of a royalty agreement? What do we need to consider when negotiating a royalty agreement?
Sure. And again, I'm just going to focus on the net smelter return royalty rather than getting into the myriad of other kinds, which, again, for those who aren't familiar with it, is really just a gross revenue royalty less certain prescribed allowable deductions. And those are typically transportation costs, insurance, refining and beneficiation costs, and then ad valorem taxes. There's sometimes a debate about whether marketing costs get backed out in some instances. And so you can negotiate that, but it's a pretty tried, tested, and true formula. I think one of the key points that often comes up in the negotiation of an NSR royalty is a lot of the land packages we're talking about have been explored going back decades. They've changed hands, and over the course of that period, different claims may have different royalty levels on them. So you're in a situation where you've already got existing encumbrances, and as Alex alluded to earlier, when you start to get royalties in the 4, 5, 6% range on a particular claim, it can make the economics of building a mine extremely unfavorable. And so one of the things that I typically try to push for is effectively an encumbrance cap, if you will. So if you're looking at it, say a 2% NSR royalty, it would be a 2% adjusted downwards to the extent that there are existing royalties on the land. And maybe what you do is you put in a floor. So you say, we'll adjust it downwards to a minimum of 1% or 0.5%. But ultimately, you've got to look at this from the perspective not only of the company that's building the mine, but the company of the royalty holder, right? If I've got a royalty that is so encumbering the lands that they're never going to build a mine, my royalty is not worth much more than the piece of paper on which it's printed. So exactly. There is this comedy of interest. It exists in streaming and it exists in royalties, right? The royalty holder wants nothing more than to see someone build a mine. The streamer wants nothing more than to see someone build a mine, because that's where the real value is created for both parties. So that's kind of one aspect that we're highly focused on. Again, I see that a lot in the US and Nevada, where you have a lot of early claims and royalties that exist. Another thing that you might look at are royalty caps, right? So that can come in the form of a cap payout, right? If you're a business person who's looking for a prescribed return, maybe you're prepared to cap the royalty after you receive a certain payout amount, or to cut back the royalty at a certain point. Similarly, you might have a buyback right. So it's not uncommon to see a 2% NSR with the right to buy back 1% within a particular time frame at a particular point in time. And I tend to see those more in what I'll call the prospector royalties. So the people who have discovered the deposit and then in return for transferring it will take on a royalty. Rarely you'll see a royalty holder want to take payment in kind in the form of gold or silver, because all it is really is a deposit to a metals account. And sometimes there's an interest in getting that, although that's less and less the case. And information and access rights. And there's an interesting trend that's happening, right? Because typically a royalty holder doesn't need much information. They need to know how much gold or silver or whatever metal is being produced. They want to see off-taker sheets, and they want to be able to compute the royalty to make sure they're not getting ripped off in terms of what the deliveries are. But as royalties have become more of a business, i.e. a funding mechanism where real money is being paid for the royalty, and you're in an early stage development project, you're starting to see what I call the bleeding effect of royalties starting to bleed more towards streaming type of disclosure requests. So information about mine planning, about resources and reserves, about development plans and progress reports as the mine gets built, so they can stay abreast of what the situation is. So again, that's something that is, at least in my experience, a more recent trend, and it's not just in information rights, it's in other rights as well. Another important consideration is going to be transfer rights. Again, as Alex said, oftentimes business people are investing in a company. They like the management team, they believe in their capabilities of building this mine. And so a free ability to transfer an underlying asset or a free ability to transfer an interest could imperil the investment. And so there are sometimes certain mechanisms put into place to ensure that if the underlying asset is going to be transferred, that it's transferred to an entity that's actually capable of taking it by the horns and building it. And the flip side of that is obviously the right of first refusal or the right of first offer, because the mining company, again, typically doesn't want to have an encumbered asset. So if the royalty holder is going to transfer their interest, they're often going to push pretty hard and negotiate pretty hard for a right to buy that out so that they can relieve themselves of that encumbrance. Other important points that typically get negotiated, and there's a variance between streams and royalties, if you will, is around commingling. So the idea that you can take ore from a non-encumbered asset and combine it with ore from the encumbered asset, and what the implications are to the beneficiary of the royalty. And then again, the covenant package in terms of royalties it tends to be fairly light and typically relates to operating the property in accordance with good mining practice. But again, you're starting to see a little bit of seepage and infiltration of streaming-like or streaming type provisions making their way into royalties. So the royalties that I grew up with 10 years ago that were 5 or 6 pages are now 20, 25 pages and a little bit more voluminous and detailed in terms of what's expected and what the various rights are.
Thanks, Rich. So Erik, what do you want to comment on that, which covers a lot of issues, huh?
I mean, Richard, in I think 3 minutes, just basically went through the anatomy of a royalty agreement. So there's not much more that I can add. You know, the one interesting thing, and we're probably going to get into this a little bit with the streaming agreements, but you know, Richard touched on the buyback provision. That's obviously one thing that hasn't transferred over to a stream. You typically do see the buyback provisions in a royalty agreement, but it would be almost unheard of to include some sort of buyback provision in a stream. The streamers just flatly just reject any notion of a buyback. I think there have been a couple. So I mean, but they're very unique circumstances, and the payment for the buyback is, you know, it's quite high. It's almost an incentive not to buy it back in the streams that I've seen where it's been included. So that's one major difference. But otherwise, I would agree with Richard's sort of anatomy of what goes into a NSR royalty agreement.
Okay, Erik, thanks. And what about the anatomy of a streaming agreement?
Yeah, you know, in terms of, you know, what, you know, the most important, you know, aspects or items to see in a streaming agreement, most of it is commercial, right? As lawyers, we like to think that, you know, we're very important, but really it's the commercial terms that sort of carry the day. And so, you know, you need to know the percentage of the metal being sold, the discounted price. Those really are the two biggest factors from the mining company's perspective. You'll also, you know, want to negotiate the timing of your deliveries. Is it on a monthly basis, a quarterly basis? Is it based on, you know, once you receive payment from the off-taker, do you then have to deliver to the streamer? these are commercial aspects, and they're not difficult, but they're things you have to think about, because once you sign your agreement, it's in place forever, and so you've got to make sure that you can comply with the commercial obligations. I would agree with Richard that the covenant package in a stream agreement is probably more fulsome than in a royalty. So the reporting obligations are important. Confidentiality is obviously an important provision. Transfer restrictions, which I think we'll get to a little later on, are extremely important from a streamer's perspective. One of the things that we see a lot in streaming agreements is expropriation provisions. To my knowledge, I can't think of a scenario, and maybe Richard or Alex can correct me, but I don't think a mine has been expropriated since streaming agreements came into effect. But most stream agreements now contain very detailed expropriation provisions in case there is an expropriation. So that's something that has to be considered. And then we've touched on security. Security is a big one, and on security, I probably should have mentioned before, but one of the things with security is if a streamer is taking security, chances are it's not the only security being granted on the project. In order to build or develop a mine or expand a mine, you'll need a mining company will need more than just the stream or royalty financing. They're probably going to get project financing as well, and so then you get into intercreditor negotiations, which can be a bit complicated and time consuming, but can be done. So there's a whole host of issues to consider.
Thanks, Erik. So what about anatomy from the commercial perspective? Alex, you have any comments on that?
I think it just comes down, I mean, at least from our perspective, is just overall risk level that you're taking. I mean, I think a lot of the kind of, again, the higher the quantum, the higher percentage of that stream, the bigger role that stream plays in the capital structure, the more difficult everything becomes. And I think that's probably where you see a lot of the structuring complexities emerge, right? Because everyone is bearing that much more risk. And so I think from our perspective, it's just a matter of, I mean, honestly, we're not huge fans of structuring things too much, not to offend anyone. Just, I mean, it's one of those things where on things you really want, it's actually the structures are the simplest. On things that get more difficult, I think that's when you need a lot more protections because you have less margin for error. I think that's the reality of it. And so, it's probably the biggest danger I think the industry faces is that you get probably too big and you start becoming maybe a little bit too much like the conventional capital providers, and then your terms begin to approach that. And so I think that's probably the one thing we always look out for is you want to be right sized, and there are assets that can handle very large royalties and streams without anyone losing sleep, but there are some that can't, and so I mean, and I think that you just have to be honest about what that means. I mean, I've seen royalties put on early stage assets, which basically make them unfinanceable afterward. So that doesn't do anyone any good. I mean, you have a royalty that is very unlikely to yield any revenue. And so I think it's just a matter of understanding where things fit in. I think there's going to be a large organic place for the industry to play in the mining sector, even at the best assets, because the financing can be much more flexible and issuer friendly. Particularly in the first 5-7 years, which is an eternity for the management team, but it's not for the royalty to streamer. And I think what the markets I think have been willing to give the industry is a very long-term attractive cost of capital. So if you can show that you have 20, 30, 50-year revenue streams on super high quality assets, then that's a vital advantage, which you can then share with whoever you're doing a deal with, and you can give them a very attractive cost of capital for the short to midterm, which I think is really what the industry should be. I think the bigger you get, though, I think, and the more you try to displace conventional sources altogether, then I think you kind of your terms are going to begin to approach those same conventional sources. It's inevitable. So it's just a matter of where things fit.
Thanks, Alex. So we've been talking about some specific provisions in these kind of agreements. So Erik, what about rights of first offer or first refusal in streaming agreements? Have you seen those? Are they common or?
So I would say that rights of first offer, rights of first refusals in streaming agreements are common, but they are typically in favor of the streaming company. And so what that means is that if the streaming company is taking a stream over a specific project, if that counterparty or mining company wants to do additional stream or royalty type financings, the streamer has a right of first offer or refusal to do those, take on that additional financing if they so choose. I've also seen ROFRs in favor of streamers for, if you're dealing with a counterparty that has multiple projects, the ROFR could extend to other projects as well. It's not as common to see a ROFR or ROFO in favor of the mining company that allows it to buy back the stream. I have seen it once or twice, but I would say it's very, very rare.
Okay, thanks, Erik. So, and what about buyback provisions, Rich, on streaming and royalties?
Well, again, I think obviously streams to some extent over the life of the mine are considered a fairly expensive form of financing, right? Because of all the exploration upside that you're giving up. So we are seeing more and more limitations on the scope of streams, which sometimes manifest themselves in buyback rights, where a portion of the stream can be purchased at some point at an agreed price. And those can be event triggered, sometimes if you want a company to be more marketable on a change of control, you might be able to trigger a partial buyback. It may be available as a time limited option after a certain amount of ounces are delivered. We have a database where we keep track of streams, and from about mid 2017 to mid 2020, we found that about a third of the streams where the streaming agreements had actually been publicly filed had these kinds of buyback rights. Now, in my experience, it's harder to get these buyback rights from what I'll call the conventional streaming parties, the Silver Wheaton or the Wheaton Precious Metals and Francos of the world. They do give them up sometimes, but to Alex's earlier point, they're often financing at a fairly low rate, and the real upside for them is the exploration upside, the life of mine potential. So giving up an ability to really benefit from that upside is very costly. Now, that's not to say they don't do it, but obviously it feeds into their pricing model, and it changes the economics of the stream. Now, another approach to kind of reduce the pain, if you will, of a long-term stream is the step down in ounces or an increase in the per ounce price payable. So they would typically kick in after a specified number of ounces are delivered. And again, to take an example, if you're delivering a specified number of ounces in the first 10 years, that might get cut down by 50% in the life of mine going forward. Or if you're paying, if you're receiving 20% cash price, 20% of spot is the cash price per ounce, that might kick up to 40% after some specified period of time. And again, I tend to see these much more often in the smaller player stream so that they can be competitive against the big players. A lot of private equity companies that are looking at streaming as a way of basically ensuring a prescribed return. So once they can kind of map out what they want that return to be, they have various levers they can play with that adjust the stream and can make it more palatable. But like I said earlier on, I think as the stream space is getting more competitive, right? It used to be there were 3 players. Now you've got Triple Flag, you've got Osisko, you've got a myriad of other players who are now in the space. So as it gets more competitive, you're seeing these mechanisms used a lot more often to try to appeal, I think, to a broader base of companies when it comes to stream financing.
Thanks, Rich. Alex, any comment on that?
Yeah, look, I think the hardest thing, for a royalty or streaming company to deal with is something that caps your long-term optionality. I mean, that's really the basis for why the whole model fits in the first place. You can be much friendlier on the earlier stages because you have a longer-term cost of capital and exposure. If that exposure is taken away, I mean,
everything is better, right?
The whole conversation the whole conversation changes pretty fundamentally. So I think that with those things, whether they're ROFRs in favor of the mining issuer, whether they're buybacks, whether there's, I mean, I think those are always much tougher to discuss. I think step downs make a lot of sense in some cases because I think it's a convenient way of making the burden lower for the issuer without taking away the long-term exposure from the streamer. So I think that's a valuable thing to put in. But again, I mean, there's a point of sanity, I think, which sort of either makes sense or doesn't. But again, I mean, but whenever kind of the whole point of streaming and royalties is long-term capital. And so I think when sometimes you talk to issuers and say, oh, we need to cut it off for 10 years. You're like, listen, just go get debt. Why are we even having this conversation? I mean, this is silly.
Yeah.
It's like, that's not what we do. So it's debt or equity. If that's the objective, just take the pain now and it's yours forever. And then there's nothing to even worry about. I think you take it if you legitimately want a lower cost of financing in the initial period, which what makes a royalty in the stream make a lot of sense.
Thanks, Alex. So I think we talk a lot about risk mitigation and risk allocation. Erik, do you think something else can be said about that?
Yeah, I think the thing I would add about risk allocation is that the general premise for both streams and royalties, at least when streams first started, is the streamer gets paid when the mining company gets paid, and so streamers in theory take operational risk, and I guess royalty companies would too. So if the mine doesn't operate, the streamer or the royalty holder doesn't get paid or doesn't get its ounces or other units delivered to it. So that's a general premise, and I think over time, the streamers have chipped away on that general premise. I forget if it was Alex or Richard who mentioned, minimum deliveries, things like that. So that risk allocation is moving, more in favor of the streamers. In terms of risk mitigation, there's only, I think, certain things that a streamer or a royalty company can do. Obviously, we've talked about, faith in management, faith in the project or the asset, but really, the delivery or payment obligations are really what the streamer or the royalty holder is looking for. And so, if a mining company is not paying or not delivering, really, you try and take security, and worst case scenario, you exercise or enforce on your security. But otherwise, you really got to have faith and trust in your partner.
Thanks, Erik. Rich, any comment on that one?
I think Erik hit on the primary risk, which is operating risk. I like to think of risk in really three buckets. So there's the operating risk, there's the political risk, and then there's the financial risk. So operating risk, the one thing we didn't touch upon, and it's just worth noting because it's a distinction between streaming and royalties, is that when someone enters into a stream agreement, they agree to operate the mine and build the mine without regard to the stream. So in other words, you've got to treat the mine as though you get 100% of the economics of the mine and not slow play it because suddenly your mine is encumbered. And that's obviously a critical point from the perspective of the streamer. And from the streamer's perspective, that intuitively makes sense because effectively what you're doing is you're pre-selling the gold. So if you didn't have a stream, you would mine all the gold or the silver, whatever other commodity, and you'd sell it. Here you've pre-sold it, and that doesn't give you carte blanche to say, because I've got a huge deposit up front, I can now ignore the fact that I've got an encumbrance on the property. But so again, I think Erik touched on the operating risk. Political risk is purely contractual. So depending on the jurisdiction you're dealing with, you're going to have more or less concern about political risk, i.e., are you in a jurisdiction where there has been nationalization or where there have been unexpected, I call it expropriation by taxation. So the imposition of unexpected taxes as a way of extracting value away from the asset. And again, because the streamer is aligned with the miner in terms of wanting to see this mine built and economic value come out of that, if there's going to be a hit due to political risk, they're going to want to negotiate an approach to deal with that. And then finally, financial risk. This goes back to something I think that Erik alluded to, which is oftentimes, certainly in the early stages, stream financing is a piece of a broader financing package. So you have all of these inter-creditor arrangements. And again, it's nice to preemptively try to figure out what it is that the streamer is going to want. But until you sit down with the project finance folks, you don't know exactly what the streamer is going to get. And I think in my experience, what the streamer really wants is a seat at the table, right? Ultimately, everyone's aligned, everybody wants the project built. But what the streamer doesn't want to do is leave it to the operator to effectively set out the relative priorities of the various financing pieces. So from a financial risk perspective, the intercreditor terms are really there to ensure that the streamer has a seat at the table with the project finance, with the operator, so that they can put together a comprehensive package that favors everybody.
Thanks, Rich. Alex, you want to comment on that one?
No, look, I think Erik and Richard kind of have done a really good job. So with this topic.
Okay, so it seems that the streamer will want to be closer to what the mining company does. We'll have to have we want to have control mechanisms and reporting mechanisms maybe stronger than the royalty holders, right? How do you see that working, Rich? And is there any trends developing on that?
Sorry, I lost the connection briefly. So I'm
sorry. I was thinking that as per your explanation, the streamers will want to be closer to the operation and to what the mining company does. So in terms of reporting and control mechanisms between streamers and royalty holders, what are the trends, what are the differences, what are the needs, and what is happening in terms of controlling and reporting?
Right. So I touched on it, I think, earlier in the context of the royalties in terms of the information a royalty holder typically gets. And it really is enough to audit that you're getting paid that which you're entitled to. In the context of a stream, I think the dynamics are a little different, but at the same time, both streams and royalties are considered non-participatory interests, right? So the streamer is not going to operate the mine and does not. Again, one of the benefits of streaming over project indebtedness or straight debt is you don't get those restricted covenant packages in the same way as you would for regular debt. And in fact, a streaming agreement will typically have an indemnity from the mining company that says if the streamer ever gets sued because you have an environmental issue or an operational issue, you're going to indemnify the streaming company. So the streaming companies tend to be hands-offish, right? They're investing in management. And so what they're looking for, rather than pure control covenants, are informational covenants, right? They're going to want visibility into exactly what's going on at the mine. And when your streamer is a public company, they're going to want enough visibility so that they themselves can actually report on the mine. The dynamic, I think, changes from the beginning of project development to the point where you have an operating project, right? So when you're dealing with a project development stage, that's where the streamer is going to have a little bit more influence, if you will, not through positive covenants, but through negative covenants. So there are going to be various thresholds or completion dates or completion tests that have to be achieved by specified times in order to, for example, draw down on a deposit. So in an early development stage project, it's not as though the streamer comes out and says, here's $400 million, knock your socks off. What they'll say is, here's $400 million. It'll be drawn in tranches of $100 million based on achieving certain milestones and providing evidence at each of those milestones that you have sufficient capital to fund the entire construction. Because a streamer is not going to send good money after bad. They're going to want to have indicia that you're going to achieve those thresholds. So if those thresholds are not satisfied, again, the controls can be there in the form of delaying the deposit. Sometimes if it's, and I've seen this in a number of streaming agreements, if it runs long enough and say you have a completion test that has you hitting, you have to hit 90% of capacity by date specific, and by date specific you only hit 50% of capacity, it may result in the stream actually being downsized and a partial refund of the deposit. So there are, if you will, mechanisms in place to make sure people behave as they should. And worst case scenario, you'll see streams that say, if you haven't hit production by date X, some outside date, they have an option to terminate the stream to get the deposit back. And sometimes there are penalties associated with that. So it really is incentives, negative covenants to achieve commercial production. In a royalty context, because it's viewed more as a right and land, historically it's just been royalties are along for the ride. Now, that's not to say you can't put in contractual provisions that that have consequences, but it is far less common. More often than not, the royalty is tied at the hip with the land. And if the land produces, the royalty pays. And if the land doesn't produce, well, then the royalty holder is unfortunately SOL.
Thanks, Rich. Erik, you want to comment on the topic?
Yeah, I wouldn't mind adding one additional item. Both streaming agreements and royalty agreements contain your typical reporting requirements. I think the streaming agreements are a bit more comprehensive in terms of monthly or quarterly reporting and delivery of financial statements. But the one other item where reporting can become an issue is on technical reports. Under Canadian and US securities laws, continuous disclosure requirements, sometimes the streamer or the royalty company will be required to consider their investment in a project to be a material project, which means they may have to complete technical reports under 43101 in Canada. And I apologize, Alex, I don't know that. I think it's SEC rule 5 or 6. I can't recall off the top of my head. But it becomes a bit of a problem because what's material to a streamer may not be material to your counterparty in the mining company. So sometimes the streamer may have to prepare a technical report and the mining company doesn't, or vice versa. And what you don't want happening is two different entities preparing two different technical reports and issuing them to the public. And so sometimes there's a negotiation on how technical reports on the project are reported, who prepares them, who relies on them, et cetera. So a lot of times it's not an issue because, I think streamers and royalty companies take the view that they don't have to report unless it's absolutely necessary. And sometimes they tend to ask for forgiveness rather than ask for permissions, so to speak. They won't report unless a Securities Commission tells them that they have to, but other times it's unavoidable, and then you get into a negotiation about how those reports are prepared and who provides the information.
Thanks, Erik. We are running out of time. We still don't have any questions from the audience, so I think we have been very efficient in covering the topic. But there's probably a last question I would like to address, last issue, which has to do with the protection of rights under international treaties for protection of investments. Rich, if you want to comment on that, this being, of course, a very sensitive matter, especially when we go through some countries that raises concerns about the investment, right?
Yeah, look, you're absolutely right, and a lot of the mines are in jurisdictions where those do raise concerns, and that's why, as a practical matter, what you'll see is that these disputes are generally dealt with through international arbitration. Again, typically in a jurisdiction that's well seasoned, positioned to deal with complex issues, mining. Again, I knock on wood, I have yet to participate in an arbitration process regarding a stream in which I've been involved. But when the parties are from different jurisdictions, you want to make sure that the arbitral rules are sufficiently sophisticated and robust to deal with streaming agreements. And you also want to make sure that when you do your choice of law, that it's compatible with the laws of the jurisdiction in which secured assets are located, so that ultimately you don't run into obstacles enforcing your security. And that's always something that's front and center on people's minds when they think about a security package. Obviously not an issue in circumstances where you have an unsecured asset. But again, for the most part, just to briefly deviate, the biggest issues that come up in my experience on streaming agreements don't relate so much to challenging the validity of the agreement. They tend to relate to calculation issues or determinations of metal stream and the like. And typically a stream agreement will have a separate provision dealing with an accounting process or an internal expert process to resolve those in a much more expedient, expeditious fashion, usually appointing someone from a big three accounting firm with the mining experience who can ultimately make a determination as to how disputes around deliveries get handled. The bigger issues would fall to arbitration. And again, having dealt with arbitration in other contexts, those can be very expensive and time consuming.
Thanks, Rich. Erik, do you have a word on that?
No, I agree fully with what Richard said. Again, it's going back to the very beginning, though. I will say it really depends on who the counterparties are, because if you're dealing with an offshore entity and not necessarily the mine operator in the jurisdiction, that can sometimes reduce the arbitration or international protections issues, because you're typically dealing with other jurisdictions where arbitration can run a bit more smoothly. If you're dealing with the actual counterparty that operates the mine, then you may be getting into a bit more of a complicated issues.
Thanks, Erik. And Alex, on this topic, I think you will rely on the lawyers, right?
Yeah, I mean, it's not a good day when you're having to deal with this stuff too much. I mean, that's for sure. I think that a lot of the issues I think we discussed here, it really relates to the nature of the counterparties that the deals draw and the size of the investments. So I mean, typically the royalty and streaming industry outside of, I mean, there really isn't a private player right now that is a mainstream player in the sector. I mean, once in a while you'll see someone do things, but realistically, this is a public market sector. Public markets require disclosure. They require much more disclosure than obviously private issuers. So it's inevitable that you're going to see more and more requests for information, particularly with things that carry development stage risk, because that's what royalty companies, including ours, need to provide to their investors, to tell them sort of the status of what they're doing, what the business model is, and how it all fits together. So I think that's just the information rights or anything like that. That's just inevitable. And so expropriation and issues of that nature. I mean, listen, I think the streaming industry was born in a time when nobody really had to think about this stuff.
Yeah.
It was born in the 2000s, 2010s. I think the global economic model was probably different than what it is today. So I think that fundamentally these are new questions for everyone to wrestle with. I don't think there's an easy answer. It's because this is one of those scenarios that doesn't abide a neat solution. I think there's always a level of reasonableness you try to strive for in terms of what you ask for. Because again, I mean, if you try to ask for everything to protect yourself, you'll never get a deal done, because that's just the way it goes. So you need to figure out what levels of risk you're going to be comfortable with, and then you have to just go ahead. I don't think there's any other way.
Thanks, Alex. So we have a last minute question. It says, streaming shall not be paid necessarily with the metal mined. Hence, royalties shall be mandatorily be paid with the funds obtained from the sale.
I can try to take a crack at that. If the question is whether you can settle a stream with cash in lieu of metal, I think it's a question we didn't really touch on, but what you're trying to avoid is having a stream characterized as a derivative. So as we said at the outset, a stream is an agreement of purchase and sale. You're buying metal. And so if you get to a stage where effectively you have a derivative product, which is tied to the value of metal, you run the risk of having adverse accounting consequences, right? If it's deemed a derivative, then the stream gets marked to market on a quarterly basis. And once you do that, there's no turning back. So there's going to be a lot of sensitivity around staying away from having something that looks like or smells like a derivative product.
Absolutely.
Well, we ran out of time. I want to thank again all our speakers, Alex, Rich, Erik. You are great, outstanding, I think. I have some information for tomorrow's panels. I will do this in Spanish, if you don't mind. But thanks again for being with us, and thanks to the audience for still being there. So, entonces, mañana continúa el Congreso de 9 a 10:45. Hay cierre de minas. De 10:45 a 11 hay un break. De 11 a 12:30, desafíos legales para invertir en Latinoamérica. Otro break de 12:30 a 12:45. De 12:45 a 14:15, financiamiento de proyectos mineros, garantías stepping rights. A las 14:15 y hasta las 15:25 va a estar el cierre del Congreso. So this is it. Thank you very much. Leonardo, I don't know if you want to have some final words. Otherwise, we're done.
Nothing to add. You have great. You have made a terrific job. Congratulations, Seba. Congratulations, Alex, Erik, and Richard. Thank you very much for participating in the Congress. We are very honored of having you in this Congress. Thank you very much.